Going to go to Danielle DeMarco. She's our real estate investment mortgage specialist. She develops a real estate investment plan for our clients. She just doesn't give you a mortgage and then walks away. She makes sure that you're set up to buy multiple properties if that's what you choose to do. So Danielle, if you want to come on and do the mortgage market update for this week, that'd be great.
Perfect. Thanks for having me. As Tim mentioned, I am a mortgage broker here and I do focus on investment financing, which means helping our clients purchase multiple properties if that's what they want, like Tim said. So today, just kind of wanted to touch base on a quick market update. Obviously, everybody's minds are all focused on interest rates right now. It is the hot topic. So, how interest rates and mortgages work. So, interest rates are the cost of borrowing money, obviously. So when you get a mortgage to buy a house, the interest rate is deciding how much extra you're going to pay the bank for lending you that money. So right now, a lot of questions are what is going to happen to interest rates in the next few months. So in Canada, the Bank of Canada is the one that decides whether interest rates go up, stay the same, or go down, and that's related to variable rates only. So there's a lot of factors that go into that, like inflation. So inflation, when the cost of groceries, gas, goods, services goes up, we start to see inflation. So normally, if inflation is high, the banks tend to raise their rates to make borrowing more expensive, which slows down spending. If inflation cools down, then we might see rates drop. But there's always a twist. They don't always follow suit that way. And especially right now, because inflation is not consumer spending inflation. Inflation is forced inflation right now due to tariffs and political policies. So the Bank of Canada has to rethink how they're going to approach inflation as a result of it being a forced inflation instead of a voluntary inflation. How does the US affect us? So obviously the US has a huge impact on Canada. So imagine Canada and the US like next door neighbors who share a fence. If the US raises their rates to fight inflation, then typically Canada is going to follow suit because we want to keep our dollar competitive. As far as the tariffs go, and we all know taxes on goods and traded between countries. So if countries start charging each other more to trade, it can make things more expensive. The more expensive things are, that gets passed on to consumers. The more consumers are spending, inflation goes up. So if that happens, potentially the Bank of Canada could raise rates to control inflation. But again, that's where the topic of conversation comes in with the forced inflation versus the consumer spending inflation. So the jury is still out on what rates are exactly going to do. And then you got to throw in there the Canadian election. So elections obviously create uncertainty, which is what Tim and Azad were just talking about. People might delay decisions until they know what the results are going to be. And depending on the government's economic policies and what ends up happening, that also could affect rates. So what's next? In the next 6 months, we do expect the Bank of Canada to keep a pretty close eye on inflation. I wish I had a crystal ball and could tell you which way they're going. You read different articles, you listen to different economists, and some say they're going to go up to fight inflation. Others say they're going to go down because they can't go up and consumers can't afford to pay more. So there's a little bit of uncertainty around whether they're going to go up or down or remain pretty stable. Again, this is on the Bank of Canada side of things, which affects variable rates only. Fixed rates are based on bond yields. So bond yields are pretty self-explanatory. They rise and fall, and as they rise and fall, the fixed rates rise and fall to match. So, bond yields, we've actually been seeing them increase a little bit in an upward trend the last little bit, which means fixed rates have remained pretty stable. We typically don't see big increases unless the bond yields have been increasing over an extended period of time. So I would say over the next few months on the fixed side of things, expect rates to remain pretty stable. They may go up or down. I always kind of like to give this image, and I'm horrible at it on Zoom, but if you imagine a line, I'll use my pen going down, your trajectory overall is going down, but what fixed rates do in between is they do this. They kind of go just like the stock market, up, down, up, down, up, down, up, down. So on a Tuesday of one week, you might catch a great rate special and rates have dropped. And then on a Thursday the next week, we're getting notifications that rates are going back up. So right now, it's quite volatile on the fixed rate side of things. Little volatility though, like up, down, little tiny amounts, but it could happen any given day. So we're monitoring them, but we still are in a downward trajectory. So in February, Canada's inflation rose, which exceeded expectations. In response, the Bank of Canada reduced its benchmark rate by 25 basis points on March 12th, which just happened. Now there is talks, again, speaking back on the variable side with the Bank of Canada rate, there's talks that they may continue to decrease or they may put a pause. Again, I wish I had a crystal ball on what's going to happen, but with all of the tariffs and the election and everything, the uncertainty, there is a chance. I don't see them going up, but there is a chance they could go down, or there is a chance that the Bank of Canada may pause and just kind of ride things out for a little bit to see what's going to happen. So bottom line is, if anybody's telling you what rates are going to do exactly in the next 6 months, I would love their crystal ball because I'm going to go buy a lottery ticket. But they are trajectory is heading downward, but nothing drastic at this point in time. We're just going to see some slight movement, I think, over the next couple months here. So that's kind of the market update on the rates side of things. As far as fixed versus variable go, that's something we kind of wanted to touch on. We're definitely seeing more clients choose variable rate now because the Bank of Canada dropped that quarter point. The variable rate is looking really appealing when you compare it to the fixed. But then just this last week, we had fixed rates come down at certain lenders again. So then now we've shifted back to fixed rates. So again, it really depends. Part of the conversation is, what are your plans for the home? What are your cash flows going to be on a fixed and a variable rate? Can your rental property sustain an increase if the Bank of Canada was to increase, and would you still be cash flowing? So those are all conversations we have when we're looking at, okay, what kind of rate are we going to take? So that's it
Awesome.
for today.
Okay, thanks, Danielle.
Thanks, Danielle.
For anyone out there that is thinking of getting ahead and investing in real estate, or you have to access your equity in your homes, Danielle is the go-to. So just take a photo, screenshot, whatever, take her number down, give her a buzz. And we always tell our clients, you know what, even if you're working with your own bank, get Danielle's opinion because it matters.